I warmly welcome all of you to Infinity Learning Space, teaching with passion and compassion. So at the same time, I hope you will learn with passion and compassion. So this lecture is going to be very important, and I'm going to obviously talk to you on a subject which is going to be one of the most important subject when you in your journey of becoming chartered accountant, and even after becoming a chartered accountant. Because if you really look at this name, ABR, there is a bigger meaning behind that. So it's not purely a financial reporting paper. It is to elevate the role of chartered accountants, not only in financial terms, but to understand what is behind numbers, the whole process of business creating values, the role of corporate governance, the ethical behavior of chartered accountants. With all of these attributes, how to be all-rounded chartered accountants who could advise the board of directors. So that's the kind of subject that you are looking at. So therefore, especially you can see here 45% of this paper connecting to corporate governance, and although this word audit is used here, it's not really auditing, but this is a way that auditors are looking at financial statement to identify risk of material misstatement. So during next half an hour, you will really understand what it is, and then ethics. So together it is going to cover 45% of your paper. At a glance, during next half an hour, I will tell you the story of ABR, and to make you very confident that this paper you can not only get 50 marks. If you are a brilliant student, you can probably work towards becoming an exceptional student, maybe even a prize winner. So therefore, don't settle just to get 50 when you are preparing for the exam. You have to set your target at very high level. So looking at the syllabus content, right, I want you to carefully look at, this is a very different analysis of the syllabus. Now as you see, I mentioned to you two things. One is financial reporting aspect of this paper. So you can add 35 to 20, 55. So what is balance 45? That is what I said in a minute ago. So but what I want to tell, if you look at this 35 together with this 25, what does it mean? It's adding up to 60%. So 60% of this paper predominantly connects to accounting standards. This is directly how you interpret an accounting standard, and this is where you will use financial reporting standards from auditor's lens, using auditor's thought process to see what are the risks, how my financial statements, if you are a CFO, right, whether any particular balance can be overstated, understated. So we are looking from the lens of auditors or the thought process of auditors, but still it is equally relevant for a CFO to understand how financial statements can be misstated. So overall, I am making a big point here. If you know accounting standards very well, you are targeting 60% of the syllabus, right? And then there is balance 20% again totally on consolidation. That is, of course, you have to work, and I am sure my colleague Dasun will do a very good job in giving you the essence of consolidation and how to prepare consolidated financial statements with confidence, the exam tricks, etc. And then this is the overall behind numbers, what drives entities' future is corporate governance as well as non-financial reporting, 15% ethics. So this is the overall syllabus, but I made one big point, that accounting standard, financial reporting knowledge, if you connect it to auditors' methodology or the thought process of identifying how an account balance can be misstated, you are targeting 60%. And corporate governance is an interesting topic. I'm sure you can see much interesting video to understand how corporate governance practice. So also I want to give you some advice, especially this lecture is to understand the syllabus like an ocean. So this lecture will enable you to break down the complexity of this syllabus right? And to simplify it, if you want to be an exceptional student in this subject, how do you separate this complexity? How do you take complexity away and study, right, by component this subject? So therefore, like a story, in a little while I'll go to the whiteboard and tell you the entire story of this subject, so that you will understand the bigger picture, and by looking at that storyboard you can plan your entire study. How long it will take? If you are very smart and if you already have a knowledge, because you are not at level 1, you are on the verge of becoming chartered accountants. So if you are smart, definitely you are smart, that is why you are here, right, listening and getting ready for the last exam. If you understand the story, I can also recommend you a more strategic approach to study and to pass the examination and to become chartered accountants very soon. So another advice I want to give you, this is an open book examination, right? So if you look at the history, I have been teaching especially in auditing, and during last more than about 17 years, but for last 10 years corporate governance became much interested subject. And if you look at open book examination, which started somewhere in 2010, and students were very happy saying it's open book, wow. But finally, I have got several feedbacks from students how open book became a killer, because of referring to book during the exam, how students are going to kill their time, and eventually they are unable to answer the entire exam paper. So therefore it's very important, my simple advice to you, the fact that it's open book is a lot of mental relief, that you don't need to by heart memorize anything. Even when you become a chartered accountants, why do you need to memorize things? There are books you can refer, but you should know what to refer and why are you referring, right? So therefore, in that sense, my advice to you, very straight, usually, right, you should go to the exam. Now again, imagine this paper, if you look at the pilot paper, right, for example, what is the structure of this paper? So there is one case study with 50 marks, so that has consolidation and then connected this risk of misstatement and other questions that can come, even corporate governance. The time it takes for you to analyze, to prepare consolidations, financial statements and write essay type questions is really time consuming. So in that context, are you able to read books in detail and study, right? So that will be very tough. And these books, you see the sizes of these books. Now actually there are 3 auditing standard books, right? But do you need to really go through all this book during the exam whole? Answer is no. This is how wise students use open book. You have to think that you are not going to use the book at the exam unless it is a compelling reason. I will tell what the compelling reason is, right? Before the exam, you go through the books, read whatever you have to read. When I say that, you have a problem now. How do I read all this? Now, if you take your study text, there is a separate book only on this section, which is volume 2. And in my story, which I am going to unfold in a little while, I will tell you how to read every important page of this book in a more strategic manner, without spending or wasting much time. And you cannot take this book for the examination, then how do you make use of specific pages which examiner is most likely to test? That is what smart student will do. This is not open book. As far as open book is concerned, this is not auditing subject. You are not supposed to know all these auditing standards in much detail, but to know certain standards which are directly connecting to your syllabus. For example, I will take this question in my pilot paper discussion. If you take the concept of control environment, you should know what are the elements of control environment. And you have some idea during the exam, okay, I remember control environment is something that connects to, integrity and something like accountability, but you don't know what it is. but you know very well, you read it before the exam, and it is in your auditing standard book. Auditing standard number 315, there is an annexure. If you open the annexure, it lists out these elements. And now during the exam, you may want to look at that and quickly write down the headings, but not to read and understand during the exam, but just to ensure that you haven't missed out any of those headings, right? Similarly, there is a question about fraud risk factors, you don't know what to write. Remember this, these are why I mentioned to you two topics: control environment and fraud risk factors, which are very likely to be tested in the exam. Now you have forgotten what FRF, what is FRF? Fraud risk factors, right? Now what are fraud risk factors? You forgot it, but you remember you have read it in auditing standard number 240. You remember there is a triangle called incentive, pressure, opportunity, but you don't know the details. Open the book and refer to it. So this is my guidance on use of open book, but as we discuss in more detail, you will really understand how it is to be used. And also in my explanation, which I said story of ABR, you will see how these chapters are connected to my explanation. So there are 9 chapters, and essentially I will also, after this explanation, go to 50 marks question of the pilot paper and build your confidence to write your own answers. So that is the biggest reason for failures of students in the past, because when it comes to writing answers, our students struggle, right? So I want to build your confidence. Forget any suggested answers, right? If you are knowledgeable, how are you going to develop your own answers with confidence? So that's what we will do after my introduction. So with that introduction, so now we will start the story of ABR, and to understand the subject within probably half an hour end to end. So I recommend you, right, as you watch the video, you have a sheet, A4 sheet, which is a landscape, and carefully draw with me and understand each elements of it, do with me, and at the same time you may want to have your study text with you. And because this one page is going to guide you, right, when you are preparing for the exam questions, and also when you want to study some chapter or an auditing standard in detail. So let's start that. So now we are going to build our story of ABR. So remember, everything though starts with financial statements, but it is much bigger than financial statements, that you will realize in a little while. So therefore I start with what you are very much familiar with, that's financial statement. So like I told you, I want you to do this conceptualization, very strategic diagram, which connects numbers with underlying internal control systems, and also which connects with the business model, how the money is made, the story behind number, how the money is made. You can remember all these words that I am talking now: the business model, internal control system, and then the role of overall governing body, and that is your syllabus, and this is what I am going to construct. So I start with financial statements, right, and you can do with me. In financial statements, I have this rectangle for a purpose. Later you will know what this is, right? And also I will describe that set of financial statements will have 5 things, not 6, right? So what are these elements, right? 1, 2, 3 here, and other 2 here. And this is what financial statement means. What are they? Asset, liability, equity, income, and expenses. So everything in financial statements can be explained through these elements of financial statements. Then for the purpose of this subject, we will further break it down that financial statements will have 3 things which are more pertinent from anybody's perspective, especially from audit perspective. They are very, very important. And what are those 3 areas? One is transaction. So the full name should be classes of transaction, but I write transaction. Then account balances. So I just write AB to make use of the space much better. So AB means account balances and disclosures. So if you take financial statements, you know, anything can be classified under these three, and those are connected to these five. But this anybody will know. But we are interested in something much bigger than this, and what it is. So that is, I want to write that in a different color, because that's the most critical thing for you to learn, right? So when you analyze set of financial statements, you are using this framework, or when management prepare financial statements, they use assertions. Remember, in few minutes before in my introductory video, I mentioned to you accounting standards together with this auditor's methodology of identifying what can go wrong in any account balance, say PPE or financial instrument, any of that you will analyze using assertions. So what these assertions? So all the assertions I bucket under this term called pack cover. Pack cover, right? So I will explain to you and leave some little space here to write the meaning of each, but remember below also we need to have sufficient space to explain much bigger concept. So red color in this diagram I am using only to write some most critical things. So why we use this pack cover? What is in your syllabus for 25% is to identify risk of material misstatement. So the first question to ask, what is the risk of material misstatement? It relates to an assertion and then it relates to transaction account balance or disclosure. For example, property, plant and equipment valuation, right? Whether valuation is misstated or not, how do we know? So that is the understanding of material misstatement. So I want you to write few notes under each of these. So you can put a strict mark 1 and describe somewhere. I go outside this diagram to write what RMM means. And if you open and also remember, now if you want to really connect as you study this diagram to your study text, auditing standard book, you are free to do. So this explanation, 25% of the syllabus is based on one prominent chapter in your book, and that is chapter 26. So you can open that chapter, True and Fair View and Fraud Risk. So all what I talk you can find with page numbers. I can even give now page number, but then that dilute our interesting discussion now. So first thing I want you to know what RMM is. So star 1 talks about RMM. So very easy. RMM is a difference between two things. Now I want you to guess difference between what? End of the day you are auditing company set of accounts. So the balance as per company's policy, right? I write the word based on the company's policy, the recorded balance. Let's say this is PPE 100 million. So this is the recorded balance. And again, I am using red color because that's something very important. The difference between recorded balance and the balance that should be recorded based on the SLFRSs, right, or related LKSs, right? So which means if you apply property, plant and equipment LKS and even a related LKS, because see in this case you will notice that this is a manufacturing company, and also I am giving you some hint now. See, if you convert this explanation to a case study, so there is a company in Sri Lanka some manufacturing company that relies on import and export of certain equipments, let's say kind of any business you can assume, let's say this company is manufacturing stainless equipment, kitchen equipment, etc. Now the whole import has stopped and there are a lot of other issues. The demand has come down. They are manufacturing plants, some machineries are not in use for longer period. That is a risk. So in this explanation I'll connect from where risk comes, but for the time being, if there is such risk, the LK is 36, right? Impairment, because these assets are now not in use, there is a possibility that these assets to be impaired. Based on the SLFRSs, if you apply SLFRSs, special impairment, now this carrying value need to be written down to 80 million and this 20 million is a misstatement. If I say this 20 million is 10% of the profit before tax, then I am pointing out to another important concept which I go back here and link to M, and that M is another syllabus topic that you need to be aware, and that is called materiality, right? It is material. That is material, right? Now see my simple example that I took one account balance, one assertion which is valuation, and then I interpreted what is a misstatement. The misstatement is a difference between the figure recorded by the company and the figure that should be recorded by applying the relevant accounting standard, and we found this company has not done the asset impairment and the misstatement is 20. I said 20 million is 10% of PBT and it is material. If I change this and say that the impact is 1% of profit before tax, then I will say this is not material. Now what is the difference between 1% and 10%? Now that is where in your syllabus, if you go to the chapter 26, there is explanation called materiality. Now you are understanding what is materiality, which you must know in your syllabus, right? So materiality means if there is a misstatement, it is going to, now here material misstatement means if there is a misstatement, it's going to affect, the key word is economic decision of the primary financial statement users. Now that is a different word. Now that's the latest definition of materiality, right? If there is an omission means something not included in the account. Say disclosure is omitted, that's called omission. Or if there is a misstatement, in my example this is a misstatement. If that's going to affect the economic decision of primary financial statement users, then I will show this in slides. Primary is a new definition, right? Normally earlier definition was economic decision of users. So that's going to be material. Then I am saying 1% is not material. Now that is another thing you should know in the exam, right? In your study text. So now this syllabus also has, how auditors looks and say that this is 10%, therefore I am going to qualify the audit report. So then what is 10% and 1%? That is where you need to have some understanding about, currently what type of percentages auditors may use to say something is material. Say if it is 5 to 10% of profit, it may be material. And again, as I speak, this goes to, you can go and open now your study text, because if I am going to do all that now, it will, it will interrupt our interesting discussion. So all this, if you go to chapter 26, there is a page number with these percentages which you can find. Now this is profit. Similarly, some cases profit may not be a suitable basis for materiality, it may be revenue. And we may use, not 5 to 10%, because revenue is a larger figure compared to profit. It is 0.5 to 1% of revenue may be material. So what I am trying to explain to you is how we identify something called material, and then we understood what is a misstatement, right? So another important point that I want to add, you can classify misstatement into 3. one is factual, that for sure you know it is misstated, right? It's a factual thing. For example, you know the company has used incorrect rate in revenue, you know, it's factually it's wrong, right? So there are some inventory which is rejected and it cannot be used, factually it should be written off, no argument, no subjectivity. But there are some misstatements which are not factual, they are estimates, right? Estimated misstatement, which means based on auditor's judgment, impairment provision even in this case should be 20 million, right? Impairment allowance estimated, and there are some misstatements which are projected. Again, when you go through these chapters, you will come across this word. This is based on one particular auditing standard, again, Sri Lanka Auditing Standard number 450. When auditor is evaluating misstatement, auditor is evaluating misstatement from two angles. Don't only think auditor is always a number cruncher, going by 10% and saying it's material. No, even in exam question, be careful. When somebody says this is not material, you ask another question, because materiality does not only depend on the size, it depends on two things. One is size, other one is nature of the error judged in particular circumstances. So I want you to make a particular reference, that's an examinable point. By size we can say 5% is material, but by nature you can even say 1% or 0.5% or 50,000 is material. Imagine that 50,000 relates to a fraud. Imagine that if you don't disclose that 50,000, it is some losses arising from sale of entity that is going to be sold as non-current asset held for sale, something like very sensitive point. So I made a very big point now. Actually this last 10 minutes what we covered is separate standard. Materiality, you can write the standard name 320 Sri Lanka Auditing Standard. Right, this is 450. So what I explained to you, financial reporting, what is a misstatement, and this is the difference, and that can arise from these three. And then I explained to you materiality difference, materiality definition, right? Again, what the definition? If there is omission, because it connects to RMM, right? So what is RMM? If there is an omission or misstatement, material misstatement, omission or misstatement which is going to affect what? The user's economic decision making, primary user, that's material. Now coming back to this story, I may erase this in a little while because I want to bring all examinable point to this. So therefore you can go to a separate page in your note and write down, this is note 1. Then if I extend this further, I haven't explained to you assertion in much detail. Therefore, obviously, you may have to now write a strict mark 2. And that is the most powerful examinable thing. And if you want to get this 25% of the syllabus, this is the most important thing to know. Assertion. First of all, some of you may not be obviously familiar with this, and some of you may know. Now if you look up the dictionary and see what assertion means, it says assert as a verb means declare something to be true. That means you are telling, company CEO asserted that this year employee satisfaction has gone up. How do we know satisfaction has gone up or not? We don't know. It is a statement only, and that is an assertion, right? That is a general meaning. But remember, in financial reporting, assertion has a specific meaning. Please write down, right? In your note 2, like I said, I may erase this part, but better you keep your note. Note 2, assertion means what? The key word is representation by management. Representation by management, right? Which are sometimes explicit, which means it is directly shown in the accounts, right? or it may be even implicit, right? But it is embodied, it's part and parcel of financial statement. So I only highlight one word, representation by management, which means when management prepare financial statements, when they say property, plant and equipment is 100 million, they are saying all of this, and I want your careful attention to this. What they say is, number one, look here, all these 100 million assets, they are in existence. You can come and see they are there. That's existence. And this value of 100 million is valued properly based on the SLFRS. The depreciation is right, impairment is right, revaluation is accounted for properly, and that is valuation. And at the same time, company has not recorded anything which they don't have a right or obligation. Now this is an interesting point if you apply latest accounting standard, latest thought process of lease assets. Now it may not be there in the asset, it may not be in the balance sheet as an asset, but if you apply leasing standard, what is the key word? Now these words are very, very important. This is the beauty, this subject connecting to financial statement. Now let's say there is a land we are using for 20 years, right? A longer period of time. This is not in your balance sheet, but now if you apply SLFRS new standard, the definition of lease, the right to use model for 20 years, right? Although you are not the owner, it will come to balance sheet because you have the right. So new definition of asset in the conceptual framework, it describes asset as right for economic resources. Now I will ask that question, did you go through, by the way, in the study text, conceptual framework? Very, very important, because what is behind all accounting standard is one, it's like constitution of the country, conceptual framework. It defines what is an asset, liability, equity, income and expenses. And if you want to recognize an asset, the recognition criteria are what, right? Measurement, disclosure. So therefore, again, assertion definition, let me to complete. Assertions are representation made by management. This is a representation, is just one word, but remember, assertions are used for three things in financial reporting. What are those three things in any financial reporting purpose? Recognition, measurement and disclosure. So these are based on the assertion. So based on the assertion, there are three things. And now I am connecting another big thing to this diagram, right? And I'll come back to assertion again. What is that big thing? These financial statements are to be prepared based on FRF, Financial Reporting Framework. Now again, for your knowledge, remember there are two FRF. And this diagram is going to be very, very powerful, strategic one. And in about 20-30 minutes, you can see this is clouded with lot of concepts, right? So FRF has, what are the types of FRF? Now, do you know what is a fair presentation framework? Fair presentation, and the other one is a compliance framework. So FRF can be either fair presentation or compliance framework, right? So sometimes you didn't understand what I said, doesn't matter, I'll explain to you in a minute. So then, now like I said, the assertions are used. Even I can write assertion here again. Assertions are used. So assertion is like, characteristics of these account balances. But that determine true and fair view. That's the very powerful word. Again, remember, if there is a risk of misstatement, why your chapter name is given as true and fair view. If somebody asks you what is true and fair view, as a chartered accountant, can you give a very solid answer? What is true and fair view? If financial statements have been prepared without properly following SLFRS, without properly following this FRF, Financial Reporting Framework, that affects true and fair view. That leads to a RMM. So another word for true and fair view, you can also write, it's called fair presentation. Fair presentation means Fair presentation means risk of free of material misstatement. Now that tells us there is something called fair presentation framework and a compliance framework, right? So in your study text, if you go and check the chapter on the risk of, I recommend you actually, as I discuss many of the concept now from the study text, so you can go to page number 955 and see this the definition, different types of financial reporting framework. So if you look at these two framework, fair presentation and compliance framework, as I am explaining to you, I think it's good that you know this is the full story of the subject, and to build, to understand how your syllabus is made. And therefore, as I explained, I recommend you to have your study text and go to the relevant page number. So I have added those page numbers. Now, remember earlier I explained to you materiality, right? And I said, what is materiality? It is not only size, it's based on the nature, and there are certain percentages to decide materiality. So these percentages are included in chapter 27. Your chapter 27 talks about two things, going concern and materiality. Again, an examinable chapter. See, going concern can be tested in exam. If you look at now recent past, what happened? Corona. Right now with Corona, many companies' continuity is in question. Now if companies' continuity is in question, the issue is going concern. And remember, I am asking you a question, can you say going concern is a RMM? Answer is no. Going concern is not a risk of material misstatement, but it is defined using another term which we call material uncertainty. Still MU. So I am not dwelling to that now, but let's cover that later. But what I want to emphasize, if you look at page 1023, you can have some understanding about how different types of percentages. So if something more than 10% to be material, 5 to 10% is not if it is something less than 5%, you are not bothered, but going beyond this threshold is definitely material, right? So if you look at from auditor's angle, auditor will say for one company materiality level is 5%, another company 10%. So that depends on the risk of the company, so there are certain entities, if it is a listed company, so the sensitivity threshold is low, even 5% is sensitive, right? So likewise, there are materiality. Then another thing that I explained to you, the misstatements, you can look at three types factually. For sure, it is misstated, estimated or judgmental. Another word for this is judgmental, right? Estimated or judgmental. Again, you can look at page number 960 in your study text for the different types of misstatement, estimated, or another word here is judgmental, right? So that is not a factual, but there is a difference in auditor's judgment. For example, discounting rate audit is challenging in impairment calculation. As a result, there is a 20 million hit, or the cash flow assumptions are unrealistic. So it's more of judgment and then projected. So page number 960. So this is a key chapter, true and fair view chapter 26, and this is 27. So getting back to our main discussion. So what I was explaining to you, assertions. Now assertions are how assertion can be used to explain a misstatement, and then I said in that explanation SLFRS comes. So this overall term for SLFRSs, when you say financial reporting framework, that is the basis for preparation of financial statement. So as ABR student, you should know there are two types of framework. One is a fair presentation, other one is a compliance framework. The page reference is page number 957. So if you go to, I will write that reference here, page 957. And now you can look at the same time you are watching the video, it's highly recommended that you look at, if it is a fair presentation framework, there are two things, that is why we call fair what are the two things? Fair. True and fair, we're going to the meaning of your chapter. To be a fair presentation framework, company may go beyond the disclosure requirement of the standard. Because to give a fair picture, one company wants to say more than, let's say Corona is a good example again. Corona impact. Company may want to explain in much more detail than some of the relevant accounting standard, maybe provisioning, things like that. Go beyond. So I write only the word beyond. So please, you can now, for example, if you read, go to page 957, the first line. If you read the book, it says, fair presentation acknowledge explicitly to achieve the fair presentation, right? Management may want to provide disclosure beyond. You can underline the word beyond. Right? You give information beyond, especially disclosure. The other point is, to achieve fair presentation, in rare cases, company may depart from accounting standards. So, depart. See, I am using keywords here, right? So, you don't need to memorize. Later, if somebody asks, what is a fair presentation framework? The whole idea is, a company may decide to give beyond the requirement of the standard to give disclosure, or they may deviate from accounting standard in very rare cases. But one company can't say, I am not valuing inventory at cost or NRV, whichever is lower. Now, those are very fundamental things, difficult to challenge, but certain requirements somebody may challenge. If I follow in this case this particular standard, it is going to distort my set of accounts. So that is the freedom given under fair presentation. But remember, compliance framework is like law. The best example to take law. Set of accounts to be prepared based on Inland Revenue Act. Now, can you say I can deviate from Inland Revenue Act and change the tax figure? No. So, compliance framework, you can't, go beyond. So, that's something you need to understand. But my key thing is to explain to you assertion. So, assertions are used in the recognition, measurement and disclosure of financial statement, and those are the three elements in the FRF. So now I want you to refer to page number 958 again, and one before last paragraph, right? Page number 958, it is mentioned that assertions are used, right? I mentioned here two words. Explicit means it is written. Now in the annual report it is mentioned that the sale is accurately reported or whatever, something when something is disclosed. The disclose is explicit. Now implicit, now company doesn't say sale is accurate, it is obvious sales are to be accurate. That's why if you read this word explicit or implicit, embodied. It's embedded in accounts. So that is the definition. If you now go to page number 958, the assertion explanation which is given in the book, right? And then especially one before last paragraph, in representing financial statements in accordance with FRF, applicable FRF in Sri Lanka, SLFRS, management make implicitly or explicitly assertion regarding three things, and that's very important to write those three things. One is recognition, other one is measurement, other one is disclosure, right? So now these assertions you can connect to recognition, measurement, disclosure. So now we will quickly have an explanation to interpret the meaning of this assertion, taking some real life example so that you are very clear what it is, and then you can connect it back to, is it a question of recognition, measurement and disclosure? But for your understanding, see, this has very specific meaning in financial reporting. Recognition is the process where element, if it is an asset, whether you are going to put something in the balance sheet as an asset, that's called recognition. To recognize something, number one is any asset should meet the definition of asset given in the framework, conceptual framework. Asset is an economic resources, right, for an economic resources. That's the definition. If there is any asset where it doesn't give company a right for economic resources, right, So then that is not an asset. The recognition criteria is not met. The other one is ability to reliably measure. So that has to generate cash, right? Things like that. So there is a recognition, and any accounting standard will talk about initial measurement, subsequently fair value, cost, and so on, and then there is a disclosure. So these three can be interpreted, analyzed to see there is a provision, it cannot be recognized as a provision, right? So therefore provision does not exist. Existence is not there, right? So I want to add this word. When we say right, we also say obligation, right? Right for an asset, obligation for liability. So now I want you to write, and I want you to come to page number 959 of your study text, right? Page number 959, where these assertions are listed. So I will write again page 959, and then you may want to read the meaning of this assertion. Let me to take 5 minutes and explain to you. Please write with me. So I am not writing these words here, so it is going to clutter my diagram. So I want you to make, in small letter, presentation, accuracy, classification, cutoff. So that I will write cutoff, right? O for what? Occurrence. V for what? Valuation. E, again here we will write V and A, right? Valuation and allocation. Allocation means things like depreciation, right? Impairment. In some assets we make an allocation. Valuation, allocation. R means right, O means obligation. So did you write that down? So the next thing which you can go back to, that's why I said I will erase some of this, and I want to explain to you. If you want, you can put example 3 to understand what assertion means, right? So I will use this space, take an example, quick example, so that you understand what assertion means, right? Say this is an export company, right? And we are talking about revenue recognition, and SLFRS 15, 5 steps process of revenue recognition, performance obligation, all of that. You understand that, right? Because without FRF, revenue recognition standard, we can't talk about any of these assertions. So therefore you should understand 5 steps process of revenue recognition, right? So starting from the contract, right? So identifying performance obligation, determining the price, allocation, identifying point at which revenue is recognized. Is it at a point when the control is passed? See the word control, earlier regime is risk. Now new standard talks about what point control is passed, right? And then is it over a period or at a point, right? So all of that you have to look at. But I take a simple example of a company. Now this company is exporting goods. Now I took an example earlier. Say this company is manufacturing some kitchen equipment, stainless stuff, and they are exporting, and usually Incoterms. Now that's the important word, Incoterm. If you Google, Incoterm means international commercial terms. There are various terms like FOB contract, FCA contract, right? Now if you take FOB contract, what is FOB? Free on board? When the goods are, right, on the vessel. Now if I draw a vessel here, when the goods are on the vessel, then only you can recognize the revenue. But if you take a FCA contract, when goods are handed over to a forwarder who will eventually hand over to, and now see what is the contractual document here? BL. What is BL? Bill of lading, right? So that's the official document issued saying that goods are on the vessel and it's handed over, it's ready to go, vessel is going to sail, right? So at that point you recognize revenue. Here when the goods are handed over. So my key point here, I want to explain to you some assertion here. Now if you take one company, right, and we find the case I want to explain to you this assertion occurrence first of all. What is occurrence? Now you can write a note and you can also go through the book. And another thing I want to say, if this assertion definition, if you want to, all these are there in Auditing Standard book, right? In Auditing Standard book, right, the most of the topic that I am talking now is from one fundamental risk assessment auditing standard, which is Auditing Standard number 315. So you can write somewhere here, from auditing angle, how audit is evaluating the risk using 315 auditing standard. Sri Lanka Auditing Standard 315, and also in the version now Institute has issued 2020 Auditing Standard, which is the latest one. If you are having the old Auditing Standard, if you go to page number 315, coincidentally you have the assertion also in the same page, right? But now page number may be different in the new book. So what I want to say, in my example of export company, occurrence means, look at the definition of occurrence in the Auditing Standard or study text. Occurrence means this company has recorded a sale of, let's say there is a sale, right, which took place 31st March 2020. There is a sale amounting to 20 million, that's a major sales. Say, let's say this is in dollar now, functional currency is dollar. This is a major shipment that is 10 million US dollars, sizable one, right, significant one. But the date is 31st March 2020. Now what I want to say in this example, occurrence means what? Because if you don't understand this assertion that this 25% of the syllabus you are not, confident, you cannot properly analyze. So the point is, occurrence means recorded transaction has occurred. Now you better write that, right? Recorded transaction, has it actually occurred? Recorded transaction, right, occurred and relevant to the company. See, recorded transaction occurred. Now what does it mean? In the ledger, 10 million is recorded, but do we know has it occurred? At what point it occurs? Go back to SLFRS and ask at what point revenue is recognized. If this is a 4B contract, now has recorded only based on the dispatch note. Dispatch note, let's say invoice for the easiness, the record means in company's ERP system they have raised the invoice, that's it. But still goods are within the company's premises, it doesn't reach the vessel. So if you apply a 4B term, this transaction, although recorded, it has not occurred. It has not occurred. It has never occurred on 31st March. So what assertion is going to fail? Occurrence assertion failing. Right, again I am writing something here but which I will erase, which you can write, okay, I will write here itself, right. So I am writing two things here now. One is transaction, other one is account balance, right. So my transaction is sale and my balance is debtors, receivable. So I know occurrence assertion has not satisfied. There is no sale as at 31st March. And also I know if there is no sale, debtor is not in existence. Existence is not satisfied. And I also know that there is no right assertion also not satisfied, because company does not have right to recover that asset. Right, and also I know the fact that sale at 31st means this is a special day, because this is the last day of your financial statement, that 10 million is to be removed and it should ideally go to next financial year if this client year end is March. So therefore this not only occurrence, it is going to misstate cutoff assertion. Now you see how we connected to assertion. The cutoff is wrong. In this particular, if this is an exam question, this is the answer you will write. There is a misstatement of 10 million, you can also give which is 10% of profit or whatever, you can indicate the size. There is a misstatement of 10 million because the revenue has been recognized, right, before the control is passed, and according to the contractual terms, which is FOB, revenue should be recognized only when the goods are on the vessel and the company has recognized at the time of raising the invoice. Therefore, this transaction should be reversed. That's the answer in the exam. Very short answer. If you write more, you're wasting time. So now I explain to you few assertions. Through that explanation, occurrence done, existence done, right? All of that done. But I want to tell you one of the toughest assertion to audit is completeness. So I want you to write that meaning of completeness as well, because the completeness means so please write completeness means all transaction that should be recorded. All transaction should be recorded. That should be recorded have actually been recorded. See, imagine it's very tough to audit, right? Now, how do you know now what should be recorded? What they have reported, we have say 900 million revenue they have reported, right? Now, we don't know this is what should be recorded because this 900 million is equal to invoice. But if we now know their point of recognition of revenue is not only invoice, we have to look at the shipping details. You may have to do a reconciliation. Now see that word later, I will explain to you, reconciliation. The reconciliation becomes a control. That's a very big point that I highlighted now. If you don't have a reconciliation is an internal control. So internal controls are critical when we analyze RMM. So if there is no reconciliation, what will happen? We don't know whether this 900 million represent the goods that have actually been shipped based on the BLL date. So that is a tough assertion. All transactions that should be recorded have actually been recorded. So with that, I have covered completeness. Accuracy is very easy. Accuracy means accurate, arithmetical accuracy. Presentation is understood. So all these assertions, I have classification is very easy. So all the assertions now you have understanding, but now again you spend your own time. This is I talk. You talk to you and understand whether you understood it. That's how best students do, because you have to internalize what I say. So basically, with that I cover my explanation on assertion, right? I have to come back to my main analysis of telling you the story of this subject, like a story how it evolves. So I removed this additional explanation from the diagram. Right, so now I can come back and explain to you, because I gave you a few examples, it's easy for me to take on. So now what I am going to do is I will draw this circle. I will draw this circle around the financial statement, and that is a very big concept in your syllabus, this circle, because the idea is circle is around the financial statements, like protecting the financial statements, and the meaning of the circle we will discuss. And I want to also tell you now we can go into much detail of this RMM. So therefore, I am taking out, I am going to explain to you, my next explanation is what are the two elements of risk of material misstatement. RMM, the first aspect is inherent risk. Again, very, very important for you to understand what IR is. IR, inherent risk. So I am bringing, so I am also writing here this term so that you remember this. IR can be explained in using two C's. right, to cums, because I am going to put here 2 C's, 2, 3, 4, 5 characteristics of an inherent risk. 2, 3, 4, 5. In the exam, this is like a picture. It will come to your mind by looking at a case study. Can this be an inherent risk, right? And it's also important that you understand what inherent risk is. Why I am now only explaining to you what an inherent risk is. I have covered assertion, right? Now I will also say we are in which page number, because when you talk about risk, so I will write here page number 961. You can see inherent risk definition, page 961, inherent risk definition, right? Okay, so what I want to say, forget all the books. Now we say that it is an inherent problem that when you are living close to the sea, that you are, your life at a risk. If tsunami or something comes, if you are in certain areas, flood is an inherent risk. Inherent, you can't avoid it, is there. Now what is inherent risk? In page number, if you refer to the definition in page 961, I hope you have opened page number 961, it says susceptibility. Looks like a big word. Susceptibility means possibility. Susceptibility that an assertion can be misstated. Now see, the definition you can't understand if you don't know what assertion means. Susceptibility that an assertion, right, can be misstated individually and collectively, right? That is the definition, without taking into account internal control. If you look at my previous example, that I said this company has to reconcile invoices. Invoice means invoice in the system. But whether goods have sailed on the vessel, we don't know without looking the bill of lading in detail. So invoice and shipping detail reconciliation is the control. Now if you forget that control, is it inherently high in this company that sales can go wrong? Depends. If that company is not having, we can't say inherent risk is very high, because this is a straightforward one, because you have to record the revenue by looking at the shipment details, right? But then if you put it in this way, this company has several contracts. Earlier I gave only example of FOB, but there are sales, some sales, you have to apply FCA criteria. FCA means handing over. This is not fellow chartered accountant, right? This FCA is a contract. When you hand over goods, this is goods on the vessel, right? And then there are CIF contract. The goods has to reach, it including all inclusive, right? Now there are different invoices. We don't know which one is applicable. Now this is really complex. Now I can come and write, I said here 2 C's, I will write 1 C is complex. That is wonderful. Complex, when there is an complexity, inherent risk is high. So that's a very good example. Now you can write, this company has multiple contractual terms. As a result, revenue recognition is complex. Therefore, misstated is an answer in the exam that you will write. So that is one characteristic. Here 2 C's, complexity, right? The other C is change. And that is a very big word. Change, change is a part of our life. Now our life has significantly changed after Corona. Even businesses have started, people are working from the home. Some businesses have disappeared. New business models have emerged. Now these changes that have happened, the technology is changing. Now if company is unable to change, that is the biggest risk company is facing. So I am writing, the biggest risk that company can have is if they are unable to change. And I want to write here most important concept more than financial. Now we are going beyond the financial statements to talk about business risk. And I want you to put a asterisk mark here. Now up to now we have written important note number 1, and I think we wrote about 2 notes. Note number 1, we are talking about risk of material misstatement. Note number 2 here about assertion. Our note number 3 is about business risk. And I will give you again page reference for business risk, which is a very important concept in your syllabus. Right, so I'll come to that and I'll give you that. Now, why I took that example suddenly, because remember, some of the business risks may lead to change, and that change will affect your account set. For example, that there is, even if you take your pilot paper, the Pinnacle case study, they have different types of sub-segments. So one of the segment is solar. And they say in the case study, this company has not adopted the latest technology. Now let's say technology is changing. Now if you don't upgrade with the latest technology, that is a change, and the business you will suffer because you are not changing the technology, competitor has changed and grabbed the market share. That change is a business risk, and business risk means you will not achieve. Let me to write on the top what I will cover in a little while. Every business is there to achieve business objectives. Now what I write on the top are very, very important. Every company has to achieve business objectives, and to achieve those objectives they need to have strategies. Now this is where I go beyond financial statements to the bigger picture of the business in terms of business objectives and strategies. And remember, if there is any what? Now let me write here these words. If there is any condition, right? Events like you can say corona or flood or whatever, right? Condition is a special situation that company's financial condition in doubt. If there is any conditions, events, action that the company is taking to close down a factory, or inaction is where company is not adopting the technology. If these condition, event, action, inaction is going to affect business objectives and strategies, that's called a business risk. So let me to give the page number, because this is examinable. I'll give you page number for business risk when I give overall page numbers. So but I haven't explained this in detail to you, but I just build the connection that when there is a special financial tough condition or an event that have happened like tsunami or corona or any government restriction, or that bad action that company is taking, that company is doing some unethical thing, or that the company is not changing, that is called inaction, that leads to a business risk, and that business risk is going to be a part of this inherent risk. So I was explaining to you inherent risk using 2 C's UMS. So I wrote here change, complexity, and what are the other words? What is U? Uncertainty, and then we have, what is M? Management bias. I am going to explain to you all of this. Management bias, and last one is subjectivity. And after this, after explaining this story, I'll go back to some slides and show you some practical example of inherent risk under each of these, so that you will understand. So already I took the example of revenue recognition here and explained to you complexity, and I took the example of pilot paper and explained to you technology change. If company is unable to change, it is an inherent risk which will come and hit the balance sheet, that is valuation, assertion, property, plant and equipment impairment. Now what is uncertainty? Certain balances in financial statements, they are inherently imprecise. This word I want you to remember, and in this diagram whatever I am writing in red, they are critical, right? So I write this word MU. What is MU? In auditing there are 2 MUs. One is a material uncertainty, other one is a measurement uncertainty or estimation uncertainty. Now there are certain figures in set of accounts. For example, there is an investment in a private company. If you apply SLFRS 9 fair value model, because equity instruments are to be fair valued, there is no market price, you have to use your own valuation model, the answer is going to be subject to high inherent That's measurement uncertainty. And management bias comes when management is under pressure. I am connecting this to FRF. And again, I have written this in red color. Remember, whenever something red, that is examinable. Especially fraud is a separate part of your syllabus. And I told earlier, chapter 26 is true and fair view and fraud risk. Right? In chapter 27, we discuss going concern and materiality. So, the point is, management bias means, especially when there are tough times, I will explain this separately. Management intentionally manipulates some of this for window dressing, right? To have a better picture. And again, subjectivity is due to the assumptions, subjective assumptions used. Again, this is very similar to this uncertainty point. This is mostly applicable for estimates and fair value. If you refer to your study text in chapter 26, they are talking about a separate auditing standard, but you don't need to study these standards in much detail. But just to understand, auditor is much interested in estimates and fair value, because that is where management can change the assumptions and change the figure. You know, sometimes company change discounting rate by one figure and have a millions impact on the P&L. So that is subjective. Right, and that leads also to uncertainty in the measurement. That is why auditor is auditing this specifically under 540, because I discuss it now and with the page numbers of the book. And I want you to note page number 963 talks about this estimation matter. Page 963. You see, this is going to be the most powerful 1 hour of the lectures that I am doing for you, because this is going to tell you the whole story of a very complex subject, right? So now we have covered up to now inherent risk, but I am now going to draw another circle, and I said there is something big. This circle has a much bigger meaning, and I am also drawing another circle here and asking you what it is, and that has again another meaning, and you must know what it is. Now, we will take the same example without taking many examples, otherwise I will make this lecture much longer one. So, I want to make it shorter, and also you understand the full picture. Now, if you recall my earlier example of sales based on the terms of FOB, what time you should recognize the sale, etc. Now, I want to tell you, we consider this company revenue recognition. Now, what assertion? There is an exam question scenario, and that scenario says there is a manufacturing company, export company, and they have multiple types of contract. If this is the case study, at the end examiner is raising this question, evaluate the possible material misstatement. You are writing one answer. Heading of the answer is RR. What is RR? Revenue recognition. What is the standard? SLFRS 15. The revenue recognition standard, you are going to say why revenue can be misstated. Now, this is the answer you will write. What is the answer? There is a possibility that the revenue can be misstated because revenue recognition is, I take a word from here, is a complex process because it involves multiple contractual terms, and the point at which revenue recognized varies based on the contract. Therefore, inherent risk of revenue recognition, remember now you have to say which assertion can go wrong. Most likely cut off, point at which revenue is recognized can go wrong, cut off assertion, right? So that is the example. Now, we know there is inherent. What is the meaning of this circle? And also, I have to find another color to put something so important, and I wonder whether it is red color or yeah, I will use black, red color. Now, in this whole diagram, I am putting 5 things. 1, 2, 3, 4, 5. That is a big concept. not only in financial reporting but auditing and governance. So, this one I am putting as number 2 in big letters. I have written small numbers up to now. This is big 2. Then you will ask me, where is 1? 1 will come, right? This is 2, second point. By doing that, company will know what are the risks. When you know the risks, then you know what is the third one. I think if I don't explain what 2, you will not understand. Now, if you are a CFO of a company, what may matter to you is this circle first, but I am still not telling you what that circle means to evoke your curiosity. But I will tell you, if you are a good CFO, when you become a chartered accountant, you may want to analyze before the auditor comes, in my account set, these balances are likely to be misstated, and that is called risk assessment. Right? What is the risk assessment? In your balance sheet, what are the changes in the business which is going to hit your balance sheet? Now, because of Corona, financial situation became tough and you obtain a bank loan. Under the bank loan, you have to disclose certain things. You know, that change necessitates some disclosures. And then there are what are the complex balances in your transactions, right? And you know whether managing director is very particular to reverse some provisions because to report more profit, and you are aware as the CFO, and that is where your syllabus connects to ethics. I can write it here and complicate, but I don't do that. So management bias connects to ethical behavior. So the third circle is what then? Now, this is a big point, listen carefully. I take the same example of revenue recognition. Now we wrote an answer 5 minutes before I dictated the answer. There is a risk that revenue can be recognized because company is using multiple contractual terms. Remember, if CFO has identified this complexity of multiple terms, then the next duty of the CFO is to identify the relevant control activities which will mitigate this risk. And that is the meaning of the circle, is going to protect, it's going to reduce the risk. So now I will give you some example of control activities. You can write here, I use the black color. Most fundamental control that every company should have as a control activity is don't allow one person to handle everything. Bring 4 eyes. That we call SOD. And some of you will wonder what SOD. That's called segregation of duty. Make sure there is always one person's activities checked. Don't allow one person to do dispatching, invoicing, cash collection. He can do anything and disappear. SOD. Then remember my example I took for complexity in change sales. I draw arrow to the complexity if you want, but no need. I write here another control. So what I am writing with these arrows are type of control activities. So reconciliation is a very famous control. Reconciliation. Right? Segregation of duty, reconciliation, and most fundamental control of a company. Let's say now we talked about sales. It's possible that unauthorized sales, if you remember, Satyam reported more than 7,000 fake invoices in the accounts. Right? So very important that every transactions are authorized. You know, everything has to be authorized. Then authorization is relevant to the occurrence assertion. Now every genuine transaction has to be authorized, right? So I have written here 1, 2, 3, fourth one. I will write here another control, physical control, right? Now especially cash, things like that. You have to have physical control. Now these are control activities. Now what is the auditing standard? All this is connecting to auditing standard of 315, and in your study text there is a separate chapter on internal control, and this will help you to look at that as well. So now we have learned 3 things, control activities. Then I'll tell you the fourth one. Now this box I can probably tell it's the fourth one. Why? What is the meaning of this box? Every company, when they prepare a financial statement, they have to have some information system. So please write information system. ERP and communication, right? Information system and communication. That is the fourth thing of out of those 5. You don't know what this 5 means, so I will at the end tell you what this 5 means, right? So this is information system, but again I am emphasizing you what can go wrong. Now see, every accounting standard has been followed, very good, qualified accountant, everything is fine, but you know, in the system there is some bug and there is some fraudster, you know, some person who is manipulating entry. IT guys, you know, he's trying to make sure when there is a payment that should go to employee, he go and changes employee bank account to his own bank account, salary goes to his personal account. Now this is where people play with the system. It's very important. Because you wrote information system, don't forget to write 2 golden things about any information system is to look at ITGC, IT general control, and IT application control. Now I said somebody is going and change in the bank account, which means access controls at a database level is not restricted. Now those issues are IT general control. IT application control is ensuring if there is IT system, it ensures number 1, only authorized transaction will go to the system and system will process accurately, right? That is what IT application control is doing. For example, when you press the button invoice, the quantity into price, the value comes out. So that's that. So now let me tell you one thing. This is circle is control, but I am going to break the circle here. Now circle is breaking and leaking. That leakage leads to a MM. What is MM? Here, our MM, risk of material misuse. What is breaking here? And what is the meaning of this? This new circle is control risk. And now you understood that risk of material misstatement has 2 aspects. One is the inherent risk. And why I said the circle is breaking, that if there is a control which is ineffectively, please write this word, design weakness, by design this control is failing, or that the control has not been implemented, or control is not working, which we call operating effectively. Now these all the words that I am writing on the board today, right, in this lecture will be useful when you are writing an answer. If you want to talk about internal control failure, you can always use these 3 words, but depends on the case study, right? Design means, now control is what? Is a control, right? Let's say you have your company is producing computer chips, mobile phones, smartphones like Apple, Samsung, Note 5, whatever. Much valuable smartphones is being packed and there is a storeroom which is open. Now open means a fraud risk, somebody can come and take. Design means you lock the door, but the lock is anybody can break the lock. Very simple lock. By design, control cannot handle the risk. The implementation means you have a lock, but the door is not locked, so control is not implemented. Operating effectiveness means there is a good lock, but then if you randomly go and check, some days the door is open, it is not continuously working. So now let's forget that door example, take my revenue recognition example. Earlier I said this company's revenue recognition is tough, therefore there should be a reconciliation. What the reconciliation? We have to compare 2 things, invoice with shipping details. Now this is the reconciliation. Now shipping details has bill of lading number, handover number to the forwarder. Now you can easily match. For example, invoice done, bill of lading done, term is FOB, revenue recognition is done, right? Now if it is a FCA contract, you have another day. Now this date is invoice, this is invoice, this is bill of lading, and there is another day called handover. There is another shipment that is done, bill of lading is not raised but handed over, so revenue can be recognized. You know what I am trying to say? There is a reconciliation like this. Because of the reconciliation, revenue is right, but now we find that this particular accountant left because there was a dispute with the managing director. Managing director said, forget your accounting, I want every invoice to be booked as revenue, and he put some pressure and this guy went. Now that is a big threat. Imagine you have whatever fantastic system and capable accountants, managing director is going to ruin. Probably managing director must be in this circle. That's a big point that I want to tell you now. What is the circle then? These risks are inherent risks. These risks that we are talking now, I am actually with that example, I am expanding my explanation, right? This is called assertion level risk. So what is in red are very, very important. Assertion level risk, examinable, and this circle you can describe what is inside the circle, not the circle name. Inside the circle or outside the triangle, I am going to say something, not this one, right? Something that will affect financial statement as a whole, and those are called financial statement level risk. So again, whatever in this red color, inside the rectangle, I am going to describe them as financial statement level risk. And please make a note. Now if you are making notes up to now, this is note number. So I have lost track of notes. So we covered note 1 as risk of misstatement and note 2 as assertion. Here 2 is there, and I think we had another note. Probably let's say that is note 3, and I am sure you would have made it. And let me to say this is here note 3, we found it, right? Note 3. And now I want you to write note 4. These are all examinable notes. What is note 4? The note 4 is to explain what financial statement risk. And again, I want you to study, not only listening to me. As you listen, you understand and you read it and done, and you are ready for the exam. So in your study text, I am sure this must be explained. The assertion level risk, I already said where it is covered, and now we want to look at financial statement level risk. Yes, so that is there in page number 961. Go to 3.1 of page number 961 and underline business as a whole, risk that will affect the business as a whole. But let me to give you more precise explanation than what is there in that page of the study text. But in the study text, if you want to find where is this type of inherent risk, that is in page number 961. But I want you to write with example. I am writing a few examples, right, inside this, which will affect not one assertion but many assertion. Now what is the example that I gave you? Managing director is coming, forget your accounting, I want every invoice to be booked, and that is called one of the biggest, most dangerous risks in a company that can happen. And I want you to definitely remember this. That's called management override, bypass, management override of control. The big issue. If there is a company, governance is weak. Now I am stressing that word governance. Now governance also going to connect to this picture. If governance is weak, and that is going to be, some people dominate and say, managing director comes and say, forget accounting control and you do what I want. So that is called management bypass control. So that when that happens, you don't know what assertion will go wrong. Tomorrow managing director will come and say, no impairment here, don't do any of that, I will give a call to audit partner, right? Don't do any of those. So now management override of control means anything can go wrong. Another thing where anything can go wrong is you are working for a company as an accountant where integrity and ethics are in question. Integrity and ethics. Right, integrity and ethics. And I will give you a third example which can affect any balance is that you are working for a company, no qualified accountant. Management competence is in question. And I will put another big thing where accounts can be affected overall is going concern. Now I have 4 examples here. Going concern, right? So I will circle this in a different color so that you will make management override of control, integrity and ethics, management competence. If you haven't written, I am reading that again, going concern. So your diagram may be much clear than my one. I am giving you a lot of explanation and allowing you to write down this, right? So what I completed now, please write this. Now you have to write what is financial statement risk. Now you can write these two. If you want, you can draw it like this. Risk of misstatement. There are two types. One is assertion level risk. That you can explain by way of inherent risk and control risk that you understand. The other one is we can identify financial statement level risk. So please write now. Financial statement level risk means those risks that can have a pervasive impact. That word is very important. I will write here. Pervasive impact. Not account specific, right? With many account balance, pervasive impact. As a result, many account balances can be misstated, not one, many. So I underline two words. Pervasive means many. Assertion means one or two. Now when managing director is corrupted person, you know, anything can go wrong. Tomorrow, today he will come and tell to do something unethical, right? So that is the big point that you learn now. And also now we are able to see what is this. Still I didn't tell you what is number 1 here, what that circle means. I will erase this now because I explained to you a financial statement level risk. Giving this example, management override of control means many assertion can be affected. Integrity and ethical value means same. Management competence in question means anything, especially management competence is not there means if there is no qualified accountant in your balance sheet. For example, financial instrument which is complex may not be properly valued, properly accounted for because management competence is not there, right? So going concern is a separate matter. It's nothing to do with ethics or anything, but it can have overall impact because going concern doesn't mean one account balance. The overall financial statement can be affected. Now I will erase this part, RMM part. And also because I want to cover what I write on the top is the most important part in this discussion when I conclude the discussion, right? So, I'll do that, and I can also erase this example of revenue recognition because you understood that. And yeah, I can actually erase this part because I know it is in your diagram. Because let me to clean this during next half an hour. I will finish the story of the syllabus and then you will have a much bigger understanding of this subject. So now you will wonder what this circle means. The circle means, I said I will write 5 things and now number 2 is there. Number 2, as a CFO, how are you going to identify risk? Number 3 is if there is a risk, what is the internal control in terms of segregation of duty, reconciliation, authorization, and IT control also we can put here, additional one. Information system control, and that we covered here. That is also protecting because see what I have taken as a sub circle is the same part of this. This is, although this is a separately drawn, it is a part of the same financial statements, right? And then we also learn the definition of control risk. Again, you can go to the study text and read what control risk means. It should be given. If not, control risk means the risk that right, if you can write down that control risk means the risk that internal control will not prevent, detect, correct misstatements in financial statements. Right now, we have 3 things out of the 5. And not only 3, we have 4 things, right? So we need to find another 2. Missing person, missing 2 people we have to find in this. So 1, Remember, most prominent thing, if you analyze corporate failures, was it due to the qualification of accountants? Accountant was not competent, or anything to do with a particular accounting standard, or is it to do with the overall culture of the entity, the board of directors' attitude, awareness, actions, things like that, the integrity and ethics? Now see, it goes with these words. Were there corrupted people or true leaders in the business? That overarching things in internal control is number one. That number one is a very examinable topic, and I am writing the full word here, control environment. And if you look at ABR pilot paper, you can see a separate question tested, control environment, and I simply put this word GACA, so that you will understand these 1, 2, 3, 4, 5, and let's write that GACA. And also remember, this goes as a separate chapter in your study text, and that is the last chapter called Internal Control Framework, right? And whenever you say control environment, please write the word tone at the top, right? So overall idea is that, now you please write it, because I don't write here. You can write control environment means you don't explain any account, no account balances here. Control environment definition start with control environment means governance and management. Both, governance means board, management means management like CFO, governance and board attitude, awareness and action, see AAA, attitude, awareness and action regarding internal controls and their importance. In simple word, are you working for a company where the board and CFO, they are much concerned about internal control? They want to implement new system, recruit talented accountants, and to fire anybody who is doing unethical things. That is a company where there is good governance. So therefore, I write these words, because I put the word GACA, it's easy for you to understand, but I will tell you in study text how it is there. Can you find this in the open book, auditing standard book? Yes. So, but for the time being, for simplicity, you can use this governance, and A here, I mean, you can say there are 3 A's here, right? Let's take accountability, and under C I am writing the word culture. And remember, when I say culture, I can't write culture without talking about 2 things, integrity and ethical values of the business. And there is another A, that is, I will say, authority. Not I will say, this is what is there in auditing standard, the latest auditing standard, the same terminology, but then if you are using any different study text or whatever, it is the same thing. Don't just carry it away with saying, no, another book there is another word. No, this is the latest standard 315 revised, but if you look at even study text note or any other note, you can still categorize under same heading with slight changes, authority and responsibility. But if you are a good student, you must know what is the difference, authority, responsibility, what is actually accountability. I don't know, then you don't know. But you have to know authority and responsibility. And then finally, another A, that is people. You know, without people you can't run any system. That is attract and retain talents. Right? Remember, this is an introductory lecture. If I talk about this subject, I can talk another 3 hours, but let's not do that now. But the whole point is, the governance here, your subject also has a 15% weightage on corporate governance. But this diagram talks about 25% of the syllabus. Now this is syllabus weightage, right? 25, another 15 here, 40%. Then another 30 or 35% of your syllabus is SLFRS, which is here. That's why I said this is 100% explanation of your syllabus, but here I want to write something much interesting on the top in a little while. So this is control environment. So that is the foundation of internal control. Now before I finish my explanation, I am going to write here something again very powerful and prominent, which you must know and which I will explain in my slides in few minutes. So remember, governance here means about the board. We'll use another color. You can also write some sub point. Governance is to say whether board of directors are actually independent. We are talking about accounts. Say audit committee, for example. Are they independent? Are they challenging the management? Are they exercising oversight? Oversight means, oversight also has a meaning called mistake. This oversight is not a mistake. Supervise. At board meeting where the audit committee is challenging CFO's account set and saying you can't value, investment property in this way, audit committee chair is challenging, directors are challenging, right? So that challenge is governance here. So if there is control environment, that is number one criteria to ensure financial statements are proper. The chances of RMM are reduced. Now let's see what are the 5. 1 is here control environment. 2 is the risk assessment. If there is good board of directors, good culture, accountability is taking ownership, the authority, responsibility, delegation clearly defined, there are good people in such a company, CFO is identifying all the risks that can affect the accounts, and then CFO is building this circle, that is control activity number 3 to reduce the risk. Then number 4 is that accounts are coming out from a fantastic ERP system where there are segregation of duties, ITGC like access controls, backups, everything is controlled, the environment is good, application controls are good, everything is good. Then I will also write, so I had to find another color, right? So I have another color, green, to write 5th one. So I will put something, another kind of dotted circle going around all of this, and that is to check whether you are in check, meaning that somebody in the organization is monitoring that. There are no culprit at the board level, but many companies can't challenge the board. Board is the board. But there are some companies, this party even can challenge the board, right? Not every company. Then who is this green party, right? What it is? So there is some mechanism to check whether control environment is good. Risk assessment has covered all the risks, whether these controls are actually working. Somebody is checking that, somebody we call monitoring. But for your practical knowledge, remember in organization who monitors whether controls are there and working, and that is usually done by internal auditors. And then if you want to bring another circle, right, we can bring that also. I don't know what color I should use now, but let's say if you want to do another dotted circle like this, it's also good to have it, because remember that is also part of governance. That we can say external auditing, right? And this is internal auditing. And I said I am going to write here something very powerful in a little while, right? But I may have to remember you have to have still some space here, if not take somewhere else, and I will erase this in a little while. When I complete this diagram, I will write here, right, the money making machine. Without money, no accounts, right? How business makes money, right? So that is going to be covered here in my last 15 minutes in this video. So now you can understand 5 things are covered now. So I have come to some milestone in my explanation. The 5 things, what did I cover 5? Let me to put it here. Now this is how I put it. Not I, this is a famous world recognized framework, and I write, you can also draw with me this separately in your diagram, and I don't tell you what the heading is. After drawing the diagram, we'll see what the heading is, right? I am writing 3 things on the top, and good student can easily understand what I am going to draw, right? When I say good student, I encourage all of you to be good students, up to date students, right, who are technically sound. And I am going to write 3 things here and 5 things here, and this is world famous, and whether you are accountant or CFO, anybody or board of director, this is important. 1, 2, 3, 4, 5. Is it 5? 1, 2, 3, 4, no? Right, 1. Okay, then I can write 5. And also I am putting here 17 here. Right, this is very sharp, right? 17. No 18, 17. What is it? If you look at every company, today I took the example of manufacturing stainless equipment and exporting. Now that company has to ensure their operations are smooth. Any company has to ensure there are 2 things in operation. Operations are effective, right? Now for example, in their production process, are they coming up with high quality product? And they are cost efficient. If you look at now, for example, take your pilot paper. So they say they are manufacturing cars, and then they are, vehicle engines, they are importing from most expensive countries, and they are unable to sell a product at a competitive price. They are inefficient in their purchasing price. And then you will also find in this company there are a lot of people who are not working. As a result, this company has become very expensive company. They are failing in their operating model. Number 2, if this company is a listed company, it's very important that whatever they report, that has to be accurate. So reporting. So I will say reliability of reporting. Right, this is the second thing. What is the meaning of these 3 also, you should ask from you. The third one is to say any company, there is a regulatory framework. If you take a bank cannot operate without complying with laws and regulation, compliance. So then what are these 3? Any business, they have to run their operation effectively and efficiently. They have to report right numbers. They have to comply with law. These are the objectives. Let's say this is a larger group. There is subsidiary 1, SBU. Let's say SBU, Strategic Business Unit 1, which is a banking business. Strategic Business Unit 2, which is a manufacturing arms. SBU 3, hotel. Likewise, they have areas. Any of this business, if you want to drive this objective, start with good governance. That's control environment. I will use another color. Control environment on the top. And then, especially by talking about risk in reporting, risk in the business also, risk in operation, quality or what can go wrong, they have to have risk assessment process to identify what are the risks. No point of sleeping after identifying risks. Have control activities to mitigate this risk and to ensure the right information is coming out of information system and it is communicated across information and communication. Right? 1, 2, 3, 4. Sorry, I have added additional one. The last one is to monitor whether this is working, and there are 17 principles. This is the world most famous internal control framework, COSO framework, and there are 17 principles, which is really new.